Breaking news. Jerome Powell just slammed the brakes yet again. No rate cut, no hike, just a hard pause at 4.25% to 4.5%. But here's the kicker. That single decision can swing your monthly mortgage by $487 and will likely decide whether home prices pop or finally drop in 2025. And if you're sitting on the sidelines thinking, I'll just wait for 2.5% rates again, I've got a little bit of a reality check coming your way in the next few minutes, so let's go ahead and unpack it. So I'm Austin Zabak, and I'm the boots on the ground here in Arizona, where my almost 300 real estate agent company is sprinting towards $1 billion in closings in 2025. So I live and breathe real estate deals every single day of my life. I also own a wholesaling company, and we flip a lot of houses as well. So if you want data with zero fluff and the kind of first-hand stories that only a deal junkie can tell, do me a huge favor, smash the like button, tap that subscribe button, and go ahead and comment in the comment section down below at the end of the video and let me know what you think. So what exactly went down today? Well, as the street predicted, the FOMC left the federal funds target unchanged at 4.25% to 4.5%. And economists that got surveyed by Reuters were 103 for 105 on that call, which was basically a layup. Essentially what that means is out of 105 economists, 103 of them predicted that the June 17th and 18th FOMC meeting would leave federal funds rate the exact same. Powell opened with his favorite phrase, "We remain data dependent." Translation, we're terrified of cutting rates into sticky inflation, but a hike would nuke the housing market that we accidentally broke last year. Futures traders are already gaming out the next move as we speak. CME FedWatch is pricing a 56% chance of the first rate cut in September and an 80% chance by December. Now, huge myth buster here. Mortgage rates do not move tick for tick with the Fed. They follow the 10-year Treasury because lenders package your loan and they sell that loan into the bond market. The 10-year yield floated up to 4.55% yesterday, and that's the housing market essentially whispering, "Nice try, Jerome, but we still expect sticky inflation." Quick sanity check. For every 0.25% jump in the 10-year, 30-year mortgage rates historically drift about 18 basis points. And just so you know, 100 basis points is 1%. So 18 basis points would essentially be 0.18. So if the bond market coughs, your pre-approval sneezes. Enter Freddie Mac's latest weekly survey. The plain vanilla 30-year fixed sits at 6.84%, basically sideways for the last 4 weeks. Let's play what if. Suppose the market sees a fairy dust half-point drop, call it 6.3%. On a $400,000 mortgage, that trims about $165 a month. Is that cool? Absolutely. Is that life-changing I'm buying a house tomorrow moment? Probably not, especially if the seller just bumped list price 10 grand overnight. Mortgage Bankers Association data backs this up. Purchase applications popped 13% week over week, but here's the nuance. Refinance applications barely budged. That is pure buyer scramble for inventory, not a rate FOMO. Active listings clocked 2.06 million in May, up 14% year over year, which is the largest jump in active listings since 2013. Think of it like a tide coming in, except homeowners locked at a 3% rate are kind of like the seawall. Redfin is constantly screaming supply versus demand, headline after headline, about 500,000 more sellers than buyers. In metro cities like Phoenix, Austin, and even Boise again. Yet the National Association of Realtors says the median existing home price is at an all-time April record, $414,000, making it 22 straight months of year-over-year gains. But momentum is your early warning siren. Look at Case-Shiller. March shows 3.4% annual growth, cooling from 4% in February. If that line dips below wage growth, buyers finally claw back real affordability. In Scottsdale last week, my team wrote an offer for $50,000 under list on a luxury flip, and we got a counter only $5 grand above our ask. That negotiation would have never been possible mid-2021. Inflation? CPI is holding at 2.4% year over year. Annoyingly above target, but rolling over from last summer's spike. Jobs? Unemployment at 4.2%. Payroll growth cooled, but the quit rate just ticked up. People still feel safe job hopping. GDP now. Atlanta Fed's real-time tracker has second quarter growth at 3.8%. Translation, there is zero macro panic forcing Powell to blink a little. Meanwhile, the S&P 500 reclaimed 6,000 last week on falling oil prices, and Bitcoin is tantruming its way around 104,000 like a toddler denied candy. Risk-on sentiment and cheap money rarely coexist, folks. If investors party too hard, the Fed stays sober and keeps the punch bowl under lock and key. Buyers, here's 3 quick truths. 1, 3% mortgages are gone, buried, eulogized. Even if the Fed cuts 2 full points, which they won't, history shows lenders hold back quite a bit of spread. 2, focus on total payment, not rate. Seller concessions, 2-1 buydowns, even assumable VA loans can beat headline rates. 3, timing the bottom perfectly is impossible, ladies and gentlemen. Right now, 34% of listings nationally took a price cut in the last 30 days. Here in Phoenix, I'm seeing cash equivalent concessions between 25 and 50 grand on $500,000 starter homes to $2 million custom builds. Sellers, listen closely. If you're thinking I'll wait for rates to drop, then list my house, remember, every new listing adds competition. Inventory rising 14% sounds small until you discover 5 identical 4-bedroom colonials on your cul-de-sac next spring. List right now, price it realistically, and consider sweetening the pot with a rate buydown. Investors, my people, cap rates are slowly expanding because financing costs eat cash flow. Hard money lenders are at 10 to 11% with 2 points up front. If you can't exit in 90 days, most likely the juice is probably not worth the squeeze. And flips, I'm pressing pause. Unless the exit is under 90 days for me personally, or I can pre-sell it to an end buyer. But ultimately, in this market, I'm really doing quick turn cosmetic rehabs only. Now on the personal side, yeah, I'm building a house. I locked in my loan at 6.99%. Is that a killer rate? No. Do I care? Also no. Why? Because I needed a place to live regardless. I negotiated strong terms, locked in certainty, and even got the builder to throw in a pool, something they originally said no to. And the reason I was able to pull that off is because there's not a line of buyers wrapped around the block begging to sign contracts right now. You know, people always DM me like, Austin, why not wait? Because certainty beats speculation. I believe once rates come down and global tensions ease up a little bit, maybe a year or two from now, what feels like a meh deal today might turn out to be a phenomenal deal in the future, and most likely will. And I'm betting on timing, leverage, and control. And that's the key. I control the timeline, not the market. And you know what they say? It's not about timing the market, it's all about time in the market. And liquidity? I'm holding a bunch of cash in high yield money markets and a little bit in crypto, which is obviously super liquid. Because when Jerome Powell moves, whether it's a surprise rate cut or an unexpected hike, I want to be able to strike quickly. Mispriced assets don't sit around waiting. So here's how this will shake out. Scenario A, base case. Powell holds again in July. First cut, September. Slow grind lower on rates. Housing inventory keeps climbing. Price growth flat to mildly negative in high-cost metros. Flat to low single-digit positive in Sunbelt boomtowns like ours. Scenario B, inflation flare-up. If June CPI re-accelerates above 3%, bond yields spike, 10-year pierces 5%, mortgage rates test 7.5%, and that forces deeper price cuts and knocks marginal buyers out entirely. Cash investors feast on distressed flips and tired landlords. And scenario C, soft landing miracle, okay? Inflation glides down, GDP stays positive, Fed cuts maybe 3 times in 2025, mortgage rates drift towards 6% flat, demand rebounds faster than supply, and we get a mini boom into spring of 2026. Personally, I'm betting on something close to scenario C, the soft landing. Bottom line, Powell's pause is a slow burn squeeze, not a sudden crash. The smart money moves before the headlines confirm the trend. But here's the wild card. If we wake up one morning and there's a World War III style global conflict, all bets are off. Geopolitical risk sends markets sideways, consumer confidence drops, and Powell, he won't cut, he'll hold. Maybe even tighten again because uncertainty makes the Fed flinch. And that's why I'm playing both sides. I'm locking in smart debt where I can, all while staying liquid. If Powell drops a bomb in the press conference, say he hints at a surprise July hike, then I'll make an update video right away. Although, I don't think that's likely. So make sure you're subscribed just in case. Make sure you smash that like button. Comment down below what you think the next couple of years are going to look like in the real estate landscape. Like I said in the beginning of the video, I own multiple real estate companies, one of them being a 300 agent real estate company that specializes helping buyers buy and sellers sell in California, Arizona, Florida, and Texas. So if you want to buy or sell, or maybe you even want to buy an investment property from my wholesaling company, I'll leave all of those links down in the description below so you can go check those out. Thank you again for watching, and I'll look forward to seeing you in the next video.